all want to become, an ISA millionaire, have that 7-figure ISA pot. And on Interactive Investor, 852 customers have reached that milestone, which is great.
By putting the max amount in the early years, reinvesting the dividends, and then the benefits from time to time of takeovers, I was able to build up what I believe to be, and it hasn't been challenged, the first £1 million pot in 2003.
Hello all and welcome to the Steps to Investing podcast in partnership with Alliance Trust, where today we're going to focus on a very special financial milestone, becoming an ISA millionaire. Believe it or not, it is possible if we are diligent and disciplined, and I have the perfect guests on today to help us understand how we go about achieving this. From the UK's second largest DIY investing platform, we have back on the pod Myron Jobson, Senior Personal Finance Analyst, as well as Lord John Lee, Baron Lee of Trafford, former Conservative MP, Financial Times columnist, but more importantly, an ISA investor who has surpassed that £1 million milestone. Myron and Lord Lee, welcome.
Good morning.
Good morning.
Myron, shall we start with you? Shall we paint a little bit of a picture from what you can see at Interactive Investor? How realistic is it becoming an ISA millionaire?
Thankfully, it's becoming increasingly realistic, well, especially for our investors at Interactive Investor. We all want to become, an ISA millionaire, have that 7-figure ISA pot. And on Interactive Investor, 852 customers have reached that milestone, which is great. And when you look at regions, there are 3 regions with the highest proportion of ISA millionaires, and they live in the southeast England, London, and Scotland. But I've been having a good look at our data and just having a good look at the ISA million data. I'm not sure if there is a secret source. I'm sure your esteemed guest, Lord Lee, will offer his views, and he'll probably give you some of his secret sauce. But there are a few noticeable trends, but I think the main takeaway is that patience is key. Looking at our data, there is no get rich type scheme that are powering our ISA millionaire portfolios. I think the main takeaway is the key to give your investment time to grow. Diversification remains the name of the game when it comes to investing, and crucially, utilizing the ISA allowance when you can.
Yes, okay. Well, I was going to get onto that actually. So we're allowed to put up to £20,000 a year into an ISA. Do we need to be contributing that full amount if we're going to have any hope of reaching the £1 million mark?
I think, Mark, the harsh reality is that many of us might not be able to do so, but if you can, most certainly it will definitely help you out. So I suppose the amount, at the time it takes, really does depend on the amount you can invest as well as your investment return. So just for you, Marcus, I crunched some numbers. So were you to start now and invest a full £20,000 annual ISA allowance, just assuming that this stays the same, and your investment saw a 5% annual growth, which is definitely not easy and definitely not guaranteed, and this excludes fees, it will take you 25 years to reach the £1 million mark. But if your investment grows even more, so say by 7%, again, this is net of fee, which is, I suppose, is a tall order, you can trim 3 years off that period, so achieving that 1 million mark in 22 years. But if your investment doesn't grow as much, say if it grows by 3% annually, it will take 31 years to reach that 7-figure sum.
Okay, so definitely I can see where you're saying this is a get rich slow. Lord John Lee, does this chime with your approach? Have you always maximised your contributions?
No, not always. I certainly maximised them in the early years when I was building up my PEPs, the precursor to ISAs, when they were first launched in 1987.
So this is the personal equity plans that were the original
plans, which then really the Labour government later on changed the name two ISAs, but effectively they were one and the same. But I've always believed that there are only two things you need for successful investment. One is common sense, and the other, as Myron said, is patience. And patience is the most important. And so I've essentially built my ISA over the years, brick by brick, putting in those early years the maximum amounts, not too much more recently, reinvesting the dividends in those early years, and also being on the receiving end, thankfully, of takeover bids, which normally result in a premium on prevailing prices, obviously. So in my investment life, I've probably been on the receiving end of about 60 takeovers or take privates. And of those, half, about 30, were within my my PEP stroke ISA. So by putting the max amount in the early years, reinvesting the dividends, and then the benefits from time to time of takeovers, I was able to build up what I believe to be, and it hasn't been challenged, the first £1 million pot in 2003, which is 20 years ago. And of course, one was then allowed to put in a lot less than one is now. Originally, you could just put in about £3,000 a year, and then over the years, it's gradually increased.
So that was beginning in 1986 when PEPs were first introduced.
Yeah, 87 when PEPs were launched.
87s through to 2003. That's how long it took you.
So it took me, I think, 16 years on that basis. I think I put in a total of £126,000 over those years, and that translated itself with the dividends and takeovers and what have you into £1 million value in 2003.
Myron, now at Interactive Investor, you are able to compare ISA Millionaires to your average ISA investors sort of holistically when you're looking over the tops of the portfolios. You said there weren't lots of differences, but there are some, aren't there, in terms of the assets that they hold?
Yeah, most certainly. So the first thing to mention is that it tends to be an age thing. So with an average age of 73 compared to 56 for our overall investor ISA cohort, this is very much about getting rich slowly, as you alluded to earlier, Marcus, rather than making, I suppose, big calls on stupendously risky investments. And most of our ISA millionaires would have likely started in PEPs, as is the case with Lawley, which preceded ISA. Again, another reminder that long-term wealth creation is all about discipline and process. Also, another interesting trend is that our ISA millionaires made more than 4 times the number of trades on average than were recorded across all ISA accounts. But I should point out that this may be for rebalancing purposes. In terms of where our ISA millionaires are putting their money, investment trusts continue to power ISA millionaire portfolios and account for the largest share of ISA portfolios. So that's around 42.5% compared to just 8.2% for funds. This is among our ISA Millionaire cohort. And over the long term, some of the unique features such as gearing, which is essentially just borrowing to enhance return, have helped investment trusts deliver strong long-term returns overall. But I should mention that gearing could also mean that they underperform in falling markets. And for III's broader ISA base, investment trusts and funds tend to have a similar prominence in portfolios. So 24% for investment trusts and 22% for funds. Another interesting trend I thought was that ISA millionaires are holding close to 50% less in cash than our broader ISA base, so 5% versus 10% among our broader ISA customers, which suggests that ISA millionaires are avoiding the long-term effects of cash drag, where, say, investing could reap better returns.
Okay, interesting, because yes, of course, cash can really pull down, as you say, drag on your returns over the long term. And you've mentioned investment trusts there have been a big overweight in the ISA millionaire portfolios. I mean, I suppose more broadly, are they taking stock market risks in equities, risks in shares versus, say, bonds? Does that seem to be something that ISA Millionaire investors are doing?
Well, it's quite interesting. It's quite even in that regard. So when I look at the top 10 holdings among ISA Millionaires compared to our broader ISA customer base, it's not a lot of difference. The only difference is ISA Millionaires have one more investment trust than the other broader ISA customer base. But more broadly, they both cohorts like to invest in equity-based investments, and the bond element comes as part of a broader package, as part of a collective investment, such as a fund or investment trust.
John, have you favoured certain assets over that time you were reaching £1 million, and I suppose up to today?
Yes, I've certainly favoured one class. I invest entirely in British equities. I select individual shares which have the characteristics that appeal to me, that I've learned over the years deliver. In other words, companies that are established, that are profitable, that are, in most cases, dividend paying. In other words, I don't get involved in startups. I don't get involved in biotech stocks. I don't get involved in exploration stocks. I don't get involved now in contracting businesses. Not because I don't believe that you can make money in biotech stocks, for example, but it's a specialist area, similarly with mining and exploration, and I don't have that expertise. So I stick to companies that, by and large, I can understand in terms of their activities, and where I can keep in touch, as I try to, with the people running those businesses. And over the years, when I alight on a holding in a company that I particularly like, I tend to add to that, rather than always looking for something new. And in some cases, for example, like Treat in flavors and fragrances, which is my largest holding, I probably bought it on about 30 different occasions.
And you are a Financial Times columnist. You're a financial journalist. Do you have any tips for our listeners in terms of researching investments and making smart investment decision making?
No, I certainly wouldn't go along with the word smart. I think first of all, I think you've got to decide whether you enjoy investing and whether you want to devote a certain amount of time to it. Not as much as people imagine, but you've got to enjoy, I think, reading the investment columns and reading investment magazines and discussing the stock market, and showing a fair degree of interest, perhaps going to the occasional annual general meeting or making contact with a particular company. If you don't enjoy that, then fine. Then let others do it for you. So then invest in investment trusts or funds where other people are taking the decisions. It so happens that I enjoy being involved with the individual companies and getting to know the management there. And I find that much more interesting. And therefore, for me, it's the way I've approached it. And it's been very much a central part of my life over the years.
Myron, I just want to go back to you in terms of the sort of investing behaviours that you see in terms of in the platform. Are there any ways in which ISA Millionaire investors seem to behave?
So it seems like ISA Millionaires, I suppose they are almost likely to be tax year early birds, that's what we call in the industry, as they're able to join the last minute, they can invest earlier in the tax year than, say, some other people. So some 45% of total 12-month subscriptions from ISA Millionaires were added between the 6th and 30th of April, which was quite interesting. We also look across all of our IA customers, around 27% of the total 12-month subscriptions were deposited between the 6th and 30th of April. So that's significantly less. That's almost 20% less than our ISA Millionaire cohort. But on this, I suppose it's worth mentioning that those long-term early beta investors will have that additional year in the market, which will just help power portfolios in a rising market. The early bird gets the worm. We've all heard the saying, especially in the financial media, and it seems to be the case when it comes to ISA investments. That's because more of your assets are working for you longer. Of course, there's going to be the inevitable market time risk. And that's why, as I said earlier, long-term view is really, really crucial. But I suppose it seems to be working for our ISA Millionaire cohort.
Yeah, there's a saying, isn't there, where it's time in the market, not timing the market there. And of course, as soon as you get your new allowance April 6th and you're allowed your new £20,000, you can put all of that in if you choose to. And that could give you an extension of almost a year over those who wait until the last minute to use their contributions. John, I'm just wondering, how generally have you approached the ups and downs of markets in your time investing? Because there would have been a few times when we saw some serious crashes, such as the dot-com crash, global financial crisis, etc. How did you approach that?
Well, I think you have to decide when those black swan events happen, and I've probably had 4 or 5 over the 60-odd years that I've been investing. And you have to decide, whether the end of the world has arrived, whether it's Armageddon. And if you believe it's Armageddon, then I'm not sure what you do apart from possibly climb a mountain and pray, or hide under a bed with a crate of whiskey and a bar of gold and just sort of hope. But if you work on the basis that somehow we'll muddle through and we will all survive, and broad brush, the world will recover, and a growing population will become more prosperous. Then you seize those opportunities when there is the black swan event and the market falls, to actually to buy. And they do present excellent buying opportunities. And so, for example, at the present time, because of the uncertainty in the financial market, with 1 or 2 wobbles with individual banks, clearly the financials have dipped down. I think they're pretty good buying opportunities now, and certainly looking back, I've done very well indeed when one could pick up some excellent companies on double-figure yields. And then when recovery has taken place, it can really move quite fast. But you have to take the long view, as Myron said, and be patient. And we all make mistakes. The key, of course, in investment is to avoid the losses, and we all make them. But at the end of the day, it's the losses that drag a portfolio down. So the more you can avoid the losses and the bad ones, then obviously your overall performance will be that much better.
Any big lessons from those mistakes?
Yes, I mean, I made a big mistake, or what would it be, at the start of COVID, when Aviva, which I held in quite a big way, because of its attractive dividend yield, decided not to pay a dividend, and the shares slumped. And obviously there was wider uncertainty over COVID generally and how it would all pan out. And those shares slumped, and I sold them, towards the bottom, and took a nasty loss. But then I reinvested in Aviva because the fundamentals were there, and the shares have recovered strongly and under new management, under Amanda Blank. And overall, I'm on the right side with it. But we all make mistakes. One should learn from them. But it's not easy, and it's taken me obviously a long time to gradually hone. And these days, I have to say it's increasingly rare for me to get something totally wrong. Obviously, the share can go down from what one buys it at, but thankfully in recent years I've not had any total disasters, put it that way.
Okay, we're going to go to our final section now, and that's just some key tips basically from both of you that we want on becoming an ISA millionaire. So Myron, I'm going to start with you. Top tips from you.
Well, it'll be easy for me just to defer to Law Lee, wouldn't it? A minute there. But it's what I said earlier. It's patience. Patience is key. It's not necessarily going to happen overnight. It's not necessarily a quick, get rich quick investment that we can all put our money in and then become ISA millionaire overnight. It's important to be patient. It's important. Diversification remains the name of the game. Make sure that your portfolio is diversified across different assets and different regions, so you're not exposed to to regional risk. Geopolitical issues are hitting the world now, but it's just basically it helps mitigate risk, investment risk for your portfolio. And also it's just important to utilize your ISA allowance if you can. I say this amid this cost of living crisis where household budgets are being squeezed by rampant inflation. So not everyone will be in the position to invest a full £20,000 ISA allowance. So just, when you can do so, it really is worth it. I know, past results is not a guaranteed indicator of future results, but investors can take solace in the fact that over the long period, investments do reap good rewards that outstrip the rate of inflation and cash. So if you can, it's certainly worth doing.
Okay, and Lord Lee.
Well, yes, I very much agree with that. The stock market is it's not a casino. It's not for speculation, as far as I'm concerned. It's for investing, and what one tries to do is to buy shares in a company that is solid, is paying dividends, is profitable. You've got a very small portion of it, and you hope that over the years it will grow. And real money is made on the stock market by getting into a particular company and staying with it. The big mistake that people sadly make is to chop and change, which is expensive. And so unless you want to change into something that is demonstrably more attractive, then stay with the businesses that you've got and collect the dividends, and also from time to time, takeovers will come along and remain pretty fully invested. Yes, not everyone can afford to put the max amount in each year. That doesn't matter. And some years you're maybe not able to put anything in at all. But overall, you're trying to build up an ISA brick by brick. And that's the way I've done it. I think it's the way that it will work for most people.
Okay, well, on that note, I'm just going to get a little plug for John here. He has a book, How to Make a Million Slowly, as well as Yummy Yogurt, which is for the novice investor. They're both available on Amazon. But apart from that, a very big thank you to our guests, Myron Jobson and Lord John Lee, and to our sponsors, Alliance Trust. If you would like to learn more about them, then please go to their website, alliancetrust.co.uk. Or if you've any questions for me, please email Marcus at stepstoinvesting.com. Until next time, goodbye.